Good morning, ladies and gentlemen. Thank you, Jennifer, for the very kind introduction. We will have a lovely set of panelists, and I will introduce them in due course, but we'll start with a guru on F&B. As Jennifer said, today's idea is to go through the financing element, what the investors are looking for, what they want to do, and who else but Mr. Peter Bachman to kick us off. It's the panel first. Okay, my schedule's messed up. My apologies. So we'll hear from Peter later on. But I'll be joined then by an excellent panel, all of them experts on their respective fields. We'll have Eric Bellquist of Hutton Collins. He represented Hutton Collins in the leisure, media, telecom industries. He's an expert. He currently represents Hutton Collins on the board of Byron Burgers and brings a wealth of experience to discuss what the investors are looking for, why invest in F&B. Then we will have James Hacon, Managing Director of Elliotts. James is the UK's leading restaurant marketing insight and PR is working for the UK's leading restaurant and marketing advertising agency. He is the one who helps the brands deciding how to market, how to develop, how to go forward. And I also have the pleasure of having with us Michael Ingemann, the executive chairs of Claus Meyer Holding. He's got many hats, Michael. He's a director in General Northern Food Hall. He's an investor in high-end restaurants in US and Northern Europe, in particular the famous Noma that we've all been hearing of. But he's also very much involved in charitable organizations that utilizes culinary empowerment and education to combat poverty. Last but not least, certainly, I've got Ron Pearson of Bowmark Capital. Ron is our go-to guy whenever we want to look at the pure financing aspects of it. He's been a member of the investment committee at Bowmark Capital LP, and he also leads their consumer and leisure practice. So please give him a good round of applause, and we'll get going on how to find investments. Obviously, the first question that everyone asks when they want to get into this industry is, why invest in F&B? We had a very interesting conversation earlier on the trend and the perception of F&B changing from a consumer perspective. So maybe we'll start with you, James. It used to be a treat and an occasional opportunity to go out and have fun. Is it something else now, the F&B?
I think it's become something that's a lot more mainstream, and we've certainly seen this, and very much driven from the US over the last many years ago, and has certainly flown into Europe and other parts of the world in terms of the number of eating out of the home occasions each month. And I think that what we saw during the last recession was a period where actually we were relatively stable as a sector, and that's primarily because actually it's so much within the psyche of consumers now to eat out. And I think that that's a really, really integral part of what makes our business, the hospitality business, so stable. I think you add on top of that the point that from a retail perspective, we're intangible, which means that we are always going to be on a high street or in a physical location. I think that makes us quite attractive to real estate companies, and I think that whole balance means that we're still quite a strong sector for people to want to invest in.
Perfect. So Ron, obviously the appetite is still there, but to carry on James' point, is it really just about intangibles? Is it what the investors would be looking at, about the retail element, the people, the equipment?
Well, I think there's a whole series of different points there. I think going back to why invest in F&B, I kind of went into the investment trade and thought that the leisure sector was generally quite a good thing to do, because if you look at the long-term trends, globally as we get richer, we have more money, less time maybe for certain people, but actually you have more available to spend on the leisure pound. And we found that the F&B trade is actually very attractive for that particular, if you like, for that spend. So you've got a long-term sectoral supporting trend, which is an increasing level of spend on leisure and within that on F&B, which goes back to the point you were making earlier. You know, certainly when I was a kid, going out for a meal was an occasional treat. Now it's habitual, and you hear of people buying flats and things like that in town centres with no kitchens because they're expecting to eat out all of the time, and that just habitual going out goes back to James's point on the recession. It's far more resilient than it ever was. So it's a much more resilient sector, and it's one that's in a long-term growth trend. That's why you want to invest into it. For us, we like branded restaurants because we think that you've got something that you can scale up, and it's the predictability that should come with a brand that is attractive to us. Going back to what makes that attractive, the intangible, for me, if you look at any restaurant brand, virtually all of the physical aspects are copyable. You can go and copy a menu, you can try and replicate it, you can go and copy a fit out. And some people who try and pass off names, but the fact is the physical aspects are copyable. It's the execution that really differentiates, in my view, a brand. And actually, that's not just about having one person. It's being able to ensure you get a consistency of execution, whether the unit is in Aberdeen or Plymouth, whether it is in Dubai or in Shanghai. If a brand is consistently delivered, that's the key to it. And so it's all about that execution and having systems and supports and beliefs within the company that ensure that happens.
All right. Perfect. Well, but maybe we'll go over to Michael now. And the brand element has been outlined by Ron, but when do you think, Michael, you would really qualify as a brand? Is it just one restaurant? Would it suffice? Do you need to have 10 outlets? When do you really make it up to what you can call a brand to invest in?
You should have had that question, but I think that that one single restaurant can be a very strong brand in its own market. But I think that what has changed over the last few years, on top of what you talked about before, is also that you have this international aspect. That there is an interest among consumers in understanding what's going on outside their own home markets, and restaurants have become something that people would like to read about and go and travel to and try out if they're good. I think that means that what in the old days probably would have been just a brand in its own home market now has something that has the potential of becoming a brand internationally or outside its home market, also within a large country. I think that then you also have the possibility for investors to come in and support that brand building outside the home market. I think that is also where a lot of restaurateurs are struggling, because they might be very good at having that intangible, that whole je ne sais quoi about the restaurant, but taking that to another market and replicating that and keeping that and protecting that. I think this is where a lot of restaurateurs will need investors, or at least smart money, also that can go in and support that.
But brand is not the only way to go, as we've seen. Obviously, you might invest on a single brand operation, but we see more and more a tendency also to invest in multi-branded outlets with large-scale operations or on various locations with different brands, all of them under the same group. Where do you see the difference? What would make an investor choose between a brand, a single brand operation, or a multi-brand, multi-site operation when they have money to invest in F&B?
Well, I'm with Ron. Yeah, I only want to invest in brands. Every incremental unit you open up is almost like a venture capital investment in its own right. You don't know how the shopping center development is really going to be. You don't know what the footfall is really going to be. But when you have a brand that you're investing with, there is something up in the ether that people know about and that they're drawn to. And it's all about executing that brand. Now, whether or not you invest in a holding company that owns one brand or you invest in a holding company that owns 4 or 5 brands, a lot of that might have to do with how much capital you have. You could argue that a holding company that's got multiple brands with multiple, it's going to have more sites. It's probably going to be a more expensive venture. So it really has to do with with a given investor's capital base. That said, I suppose you could make the argument that a holding company with multiple brands might be a bit more defensive. I don't know. It depends on how each of those individual brands are positioned, where they are in the average spend spectrum, what markets they're in. So I don't think necessarily investing in a holding company with multiple brands is an advantage. You could say that the holding company in question, there's economies of scale in terms of shared services, marketing, HR, property, finance, things like that. So you could cut some head office costs. But I'm a single brand guy right now. We're invested in Byron Hamburgers. We're invested in Wagamama. We're pretty happy with those.
Can I just pick up
Sure.
on that? We're invested in Drake & Morgan, and that's a bar restaurant business, London-centric, and basically each of the units is individually named. Underneath it is exactly the same business, basically. It's got a different outside. I like to describe it as you think of it as a BMW. Some are 3 Series, some are 5 Series. We don't do 7 Series. We're not that high end. And basically, some have got green, some are blue, some are black. They've got different interiors. But ultimately, inside the engine and all of the fittings and everything else is a BMW. So that's, and internally, the kind of Drake & Morgan way, the brand for the staff is very important. And they all understand, so that staff can go from one site to the other site. They all know the same systems, it's the same products, it's the same menu. But the outside looks as if it's slightly different. So that's a personalization thing. The brand is the underlying thing. So although they have individual names, the brand is actually slightly an internal thing, and then also the customers get to know that, it's a Drake & Morgan. And so they'll go from one to the other.
I'll just pick up on that. I agree with Ron, because I've been in many Drake & Morgan sites. It's a great outfit. And when you go into one, although they are individually named, you know that you're in a Drake & Morgan site. Running these things, it's not just a capital problem, it's a human capital problem, right? And so when you have that similar infrastructure in there, same menus, same chef training, same staff training, you go into a Drake & Morgan site and you distinctly feel like you're in one. So and to that extent, I would say
what we're investing in is a predictable model. And, being investment guys, we like predictability.
Yeah.
When you go into a business that reinvents itself every time, you lose that predictability. And that's where the biggest challenge lies. Yeah. It's actually predictability. There's enough things to get wrong on these things, and you try and eliminate the elements of error or potential error.
I think that's a really interesting point. I think there's a wider piece when you talk about brands as well, because one of the things that we've seen some really quite high-profile failed investment attempts recently in the UK particularly, where I think part of that is because people are trying to stretch the brand too far in many directions. So you've got, there's one example of someone that I know that's got at least 5 or 6 brand formats, and actually it's exact reverse of what Ron just said, that from a operations perspective and investors perspective, what's really working here. And I think really, really mature brands can do that well by really picking up on the icons of what consumers really love about their brands and keeping that central to what they're doing. I think you've got to be really careful all around that that's actually what you're doing and not just picking up on every opportunity that comes through your door.
Very interesting. Because speaking of challenges, although we all agree that the brand is a very good alternative to invest on when you're investing in F&B, I think we see now challenger players trying to capture some market share because of the earlier discussion, obviously, the changing habits. The grocery stores that we discussed earlier that are opening F&B spaces, trying to attract customers, keep them there. Do you think it's a true challenge to the branded restaurants and the F&B sector? So new players coming in and having their space for food and beverage?
I'll jump in. I think it is to the extent of, when you're looking at it in terms of share of stomach. Everybody's got to eat. Everybody's got to take a break. It just depends on how often they do it, where they do it, and how much they spend on it, right? So in the United States, if you go to the West Coast, if you look at chains like the Ralph's Grocery Company in California, they've got some pretty evolved F&B in their units. It's kind of almost like a food court. You've got a salad bar, you've got, a sushi thing, you know, with a guy making sushi. You've got, you know, a bakery. You know, lots of different things that are directly F&B related. And you can go there and you can have lunch, or you can grab something quick and healthy and take it out with you. We've seen that a little bit in the UK. I guess, you know, Tesco bought Giraffe. That's actually buying a casual dining concept. That's a little bit different. But, you know, I definitely think in terms of share of stomach, you know, that will affect you, for sure.
Well, I think it goes back to what occasion. And,
Yeah.
you know, you're talking
Definitely.
at different extremes. You know, you've got very high-end restaurants that are destinations in their own right that people will fly into just to go and have that experience. And that is a brand in its own right. It's down to then what other, at the opposite end of the spectrum, you have the fast food guys. And those fast food guys who just want to be, if you happen to be, I'm feeling hungry, look around and you're looking for the big arches or whatever. You know, you're kind of, it's all depends on what occasion. You know, as Eric says, you know, you need to eat at some point. It's just, what are you choosing to do? Is it a kind of, I just need some food now, and what do I want at that moment? And then what is available towards becoming a destination? And it depends on where you are on that spectrum. And are you eating out of home or in home? And I think we're all talking about where are you on that spectrum, and understanding the sort of footfall and the drivers around that of the people that are there.
Part of the reason that the grocery store chains in the United States have started to do this is if you look at F&B spend, and I think the gal who's the reporter here who was a keynote speaker yesterday morning, she was very good. You know, there was a chart, and it got up to 47% of F&B spend out of the home is with, you know, kind of restaurants, whether it's QSR, fast casual, casual dining, you know, and I think in the UK it's probably somewhere between 20 and 30%. I think, depending on where you look at the data, at some point in 2007, 2008, the United States actually flirted with a little bit over 50%. And that's got major implications for grocery store chains. So I think that's why American grocery store chains have moved that way a little bit. I mean, to the extent the UK follows that trend and other markets follow that trend, get closer to that 50% number, you know, I've got to expect that, you know, grocery store chains, because their margins are so thin anyway, are probably going to want to eat into some of that market.
But if I were a grocery executive, I would be quite worried about this trend. I know, see, how can I respond to that?
Yeah.
Just like how do groceries respond to the e-trade challenge? And I think that what we'll see is also a lot of testing and experimentation with should we build it ourselves? Should we get somebody else in to do it? Should we buy somebody? And I think that for as an investor in this space, I think it's a good idea. It's a good thing, because it also means that there's a movement in the market. There are people out there trying to experiment on how to get into the industry, and that means also there are exit opportunities.
You know,
because I think that is one of the things as an investor in this space here. Ultimately, who's going to buy them? Who's going to take over the investments when as my role peters out?
And there's some interesting concepts that have come to the market, which are a cross between retail and restaurant-y type thing. There's one company called Italy, and I know they've got a unit here in the Dubai Mall, and they're in New York, and they're in Chicago, and it's kind of a cross between retail, F&B, and, you know, casual dining. It's very interesting.
Essentially, it all boils down to maybe two alternatives if we oversimplify. If you're an investor, do you go for the high-end, relatively more expensive, experience-type investment, or purely volume-driven businesses? It depends of the market, it depends of the country, it depends of the eating habits in that particular country. But if we were to oversimplify the question to those two alternatives, which one would you go with?
I think there's no real easy answer to that. I think what you're sitting with on the stage is quite an interesting mix of actually a bit of both of that. And I think that it's really down to individual investors. There's also a point as to what the reason that you're investing. That might sound really odd, but I mean, we work with people that are large private equity firms or VCs, and that's very much, and clearly everyone's trying to make a return, but that's very much about making a significant return on capital. There's other investors where we've worked with that are private investors who actually it's about, there's a piece of ego there, there's an ego piece there too. And I think that I think it's a very difficult question to kind of pin either way. I think it's about an individual investor wanting to do what's right for them. And I think picking up on one point interestingly from Rod was the Drake and Morgan. The Drake and Morgan scenario is quite a good example of, as you said, that the kind of back of house operation really kind of sustaining. But what I find quite interesting is that at the new King's Cross development, it is called Drake and Morgan, and so is that about...
That's a whole discussion we could have
Okay.
for a few hours.
But it's quite interesting in terms of that, the moving and scalability of a brand and what that means for a consumer's perspective. And I think that the big thing that we work with people on is trying to understand what consumers think of brands and where that potential is. Because actually that's the first point, is that without knowing what a consumer thinks of a brand and the opportunity that in the consumer marketplace, then actually whether it's investable or not, I think is irrelevant as to whether it's high-end or a casual brand or whatever else.
I think investing is all about, it's a very, very personal thing. And your investment envelope is all about your comfort zone. I know where I'm comfortable. I think I know where Ron's comfortable, but I don't know for sure. But for me, where I'm comfortable is, an average spend per head that is defensible in, times of stress. That something that people can trade down to, but something that also people can trade up to, that are, people who are feeling aspirational. And for me, that's where, so average spend per head of, somewhere in the teens feels pretty good to me, or lower, if we're in coffee or something like that.
But also, I think that what you're saying is also that you know why you're investing.
Yeah.
You know what you're going for.
Yeah.
You know what you bring to the table. I think that also comes down to I think for us, we're both operators and investors. We see some of the investors that we have in our places either want to learn about a new market, and that's why they do it, or they want to, they're private equities, and they want to really have a very clear return, and they look much more to indicators like you're talking about. Yeah. And I think that if you, as an investor, make sure you understand why you want to do this and what you bring to the table, then you're also much better in the due diligence phase. And I think that a lot of people get into this and they think it might be a little sexy because it's it is in many ways, and it's very much in the media. But in the end, it's a business that needs to run. So we need to have a match between the type of business and the type of investor that fits with that.
Can I?
Sure.
In terms of, for me, as an investor, and we look to invest in reasonable scale, and there are people who invest in significantly greater scale, it has to be a branded operation, because there are businesses that, there are probably a few billion, in the UK, there are a few £1 billion value businesses, and I'm sure Eric's trying to build some of the businesses to head in that direction that he's invested in. So it's what the potential return is ultimately what it comes back to from a pure investment perspective. And with a branded operation, you have more chance of delivering a significant scale. And you can deliver it domestically or potentially internationally. And I think that's, there are very few, if you look at casual dining, fast casual, actually Wagamama is probably one of the more successful businesses that has achieved some level of international scale. But there are very few, and so it's actually finding there are some that seem to be making that traction, and I think that's where we are in the development of the market, and Dubai is a good location actually to kind of test where it's starting to actually internationalize. So for me, it all comes back to scalability, and ultimately, can you scale it in the country that it started and then potentially internationally?
Yep. But if you've decided that you're going to go with the brand, would you rather go with the brand that you know that it's an immediate success, it's been there for a while, everybody talks about it, or would you be slightly less risk averse and try the route of underutilized brands? They've been there, we see it more and more. There are a significant number of underutilized brands. What is an investor's take on that when you look at those underutilized brands?
We're doing quite a lot at the moment in terms of the brand due diligence stuff, and exactly that. I think the market in the UK in terms of investments. Ron and I were talking about this earlier. There must be 20 plus in the last 18 months of significant investments in restaurant companies. And actually, the cream of the crop have probably already been sold within the last 18 months, or at least refinanced in one way, shape, or form. And I think that what we're seeing is people turning to those brands that are underperforming and potentially have future opportunity. And I mean, we probably had 4 or 5 in the last 3 or 4 months where we've been doing significant amounts of work to try and look at the equity that's left in that brand. But it's not an easy thing to do, and I think...
Immediate question, James, obviously, how do you turn that around? Obviously, it has not been as successful as it was initially wanted to be, and you have to do something to turn that around. What's your immediate take on that?
I think a big thing is about really kind of, it's getting back to that customer journey piece and the customer roots around why people are coming and the occasions, and then trying to redefine that to make sure that it's as good as it can be to what people are looking for at a particular time or occasion. And then it's about the communication piece, and that's how we're involved. A lot of the time it's about going, we've got a brand that hasn't been performing. I mean, one example is something that's fallen from 300 sites to less than 80, need to be revitalized. And how do we do that? And it's about trying to really understand the core of what made it great in the day, or going, actually, what made it great is irrelevant in today's society. Let's look at repurposing something that people have a lot of sentiment with and using it in a different format. And I know about 4 or 5 people who are looking at the brand Little Chef in the UK right now, which could only be described as a car crash in recent years, probably. And looking at
Good luck.
and looking at it and going, well, is there an opportunity, given that there's kind of some sentiment and some brand equity left there, to put it on the high street and do something absolutely different with that brand? From my perspective, I think it's a no, but it is quite interesting as a proposition.
Well, for my take, in that case, you're just taking a name.
Yeah.
Because I agree.
Don't pay a lot of good.
You've got nothing. You've got nothing.
Don't pay a lot of
I
goodwill
think
for that.
there are some good examples in the UK of businesses that have been turned around recently. So, and very successfully. TGI's is probably one of the best examples. And Pizza Hut has done an incredibly good job on their restaurant business in the UK. So you've got some good examples. Obviously, I know we're aware of Café Rouge is on that journey, I guess. And so it's all about getting the right people.
Yeah.
And then getting the strategy right. And if you take TGI, at the heart of TGI, there was a great brand, and it was quite differentiated. And for the UK consumer, it was America and everything about it. It lost that. It became a party zone for 8-year-olds. And it just completely lost where it was going, and it got revitalized and reinvented, and got a fantastic return for the people who backed it to do that. So it's one of the options, but you would have to know and be, A, you need to get it for the right price, and B, you need to have the right management team to develop and execute the right strategy.
I agree with Ron. It's all about the people. You've got to have new people coming in with new ideas who basically say, all the rules you thought you had in the head office, you don't have those rules anymore. And you have to have people who are willing to stop saying, we don't do things like that. And they've got to look at doing things another way. Then, the other huge piece is what James talked about, which is understanding your consumer. Understanding what they think, understanding what they want, and then giving it to them and executing in a way where you can make money. And, another great example of that from the United States is Domino's Pizza. Domino's really lost its way. And they made a huge comeback, and we all know what a great success Domino's has been recently. So, you can do it. At Wagamama, I've been in and out of Wagamama 3 times since 2003, but in its current iteration, we've been in since 2011. And I would say when we bought it, things had petered out a little bit, and there was definitely some revitalization we needed to do. And the first thing we did was the brand piece that James is talking about, having a conversation with your customers, getting out there, doing 10 or 15,000 surveys, having focus groups, understanding what people want, and then people executing that. And finding the right team is a challenge.
Absolutely. There are not an abundance of them out there. We're about the end of our time. We'll take a couple of questions. If there are any questions in the audience. Gentleman over there.
would it be fair to say that investments in restaurant sector are an underdog as a defensive and growth potential? And are there any graphs for benchmarking the restaurant sector 2010 to 2015 comparing to other industries? Because as an investor, you look at FMCG, healthcare, fashion and retail, but there's very little outside that realm of perhaps educating investors of how defensive and how offensive the restaurant sector can be. And do you have those data to share with us as a benchmark? My second question is, how, as investors, you avoid two elements, which is innovation atrophy and brand elasticity containment by people like Five Guys. So if Five Guys wants to scale up, how you make sure it's not another McDonald's and keeping them in a straitjacket and allowing them to be playful because you want the returns as an investor. These are my two questions.
I'll jump in and try to answer the first one. I'll leave the brand to maybe somebody else, and then Iran's very interesting, by the way. And then I will try to answer the last one about Five Guys in particular, given that I'm in the burger market. The first one, returns, and jump in here if I say something crazy. I think it's been very interesting. The restaurant market has traded at a range of multiples. We did the public to private of Pizza Express with TDR Capital back in 2003. We took it private 6 and a bit times, right? Recently the restaurant group was trading at 12 times 1 year forward, 11 times 1 year forward. Now it's come off that for whatever reason. So it's definitely, multiples are cyclical depending on, growth expectations. But the one thing I would say, and I think a lot of this has to do with the function of interest rates. When interest rates are close to the zero bound for as long as they are, and yields have been as low for as long as they are, when you're looking at asset-light models that produce lots of cash, they should have well over 100% cash conversion if they're operated properly. Incremental returns on a new site are very, very attractive. If I'm opening sites at 2, 3, 4 times EBITDA, 25, 35, 50% return on capital sometimes higher. In this interest rate environment, that is really attractive. If you couple that with some of the trends we were talking about in terms of the amount of money in F&B that's now being spent out of the home, maybe people having less time to cook at home or a lack of wanting to, when you put all that together, I think it makes a pretty compelling investment case. That said, at the right price. And if you're paying 10, 11, 12 times EBITDA for a business, there better be a lot of growth because you're going to have to grow into that purchase price because multiples aren't always going to hang around at those levels forever. So, no, I don't think so. It depends on the market. It depends on that point about how much people are eating out of the house and how much brand awareness there is. I think, in some countries, people cook at home a lot more these days. In the future, that probably will happen less and less. In the UK, when I first moved to the UK in 1999, there were 68,000 pubs in the UK. Today, there's 50, 45. 45, 50. And I would wager, and Ron may disagree with me, I would wager that, in 20 years' time, there's probably going to be 30 to 35,000 pubs, right? That's still enough pubs. And the population's still growing, and, people are eating out more, and people now want to meet over meals rather than a beer, maybe, so I think the trends are there. The trends are there. I'll skip over the brand thing, and I'll go look at the burger thing. Five Guys is really interesting. Obviously, a great commercial success in the United States. What I think is really interesting about it is, in the United States, it's definitely QSR, right? McDonald's is QSR, Burger King's QSR, Five Guys is QSR, In-N-Out's QSR. Five Guys and In-N-Out and some of those other QSR concepts, I would call them better burger QSR, right? They have, much less stuff in their supply chain that's frozen than the other more traditional QSR guys have. The interesting thing, in the United States, they're priced at a premium to, traditional QSR, but it's not a massive premium, but they're there. In the UK market, they're pricing at sometimes a premium to casual dining. So a cheeseburger at Byron, for instance, is $7.95. A cheeseburger at Five Guys is 8 pounds. We're casual dining, they're QSR. How does that work? So your answer is, your question was, how long, they're going to scale up, that takes time. How does this all play out? And my answer to you is, well, it's to a certain extent, it's a battle of balance sheets. I may think I've got the better value for money offering given the customer journey than they do, but do I have the balance sheet to ride through what they're doing in my market? And the answer is yes. So it's a customer education thing, it's a customer journey thing. Some people are going to prefer that customer journey, other people won't, but it takes a while for the customer to get educated, and that goes all the way back to James' original point about getting out there, understanding your customer, understanding what they want, and then delivering it to them in the right way. I hope I answered your question. I tried.
I could pick up the middle bit, but I'm very aware we're quite over time. And I could speak for another 10 minutes. So if you want to grab me at the break, we can talk through that middle bit. And
Oh, yeah, sorry.
cool.
Yeah. Well, gentlemen, thank you very much. It was an excellent opportunity for me as well. I'm sure there will be a lot of questions and catching up to do in the halls. Thank you. It was a lovely morning.
Thank you.
Thank you.
Thank you.
Thank you. Cheers. Thanks, Steve.
Thank you. Okay, that was a very interesting discussion, and I'm sure there will be a lot more questions to follow. I will now have the great pleasure to invite on the stage Peter Bachman. For those of you who have been in the industry, to me, he is the guru. He knows the trends, he guides us all the time, and today he will be giving us his thoughts on generating growth. Peter, thank you.